Money market funds are thought to be among the safest investments out there, but their potential exposure to Greek debt is raising red flags for many lawmakers. That will be a big focus when the House Financial Services Committee takes up the issue tomorrow. In a hearing on mutual fund oversight, our guest, Paul Stevens, is president and CEO of Investment Company Institute. That's an industry trade group that will testify. Great to have you here, Paul, on Street Smart. So what's the main point you want to get across tomorrow in those hearings?
Well, I think it's important that both the committee as well as fund investors understand that money market funds don't have any direct exposure to Greek sovereign debt. A certain kind of money fund, prime funds, have exposure to certain global banks in Europe who in turn have Greek sovereign debt as part of their capital. But even if Greek debt went to zero value, the data that we've seen suggests that these banks would lose relatively minor portions of their equity and their assets and would not be at risk of being able to pay off the very short-term instruments that the money funds in the United States are investing in.
What data are you talking about? Because when I look at numbers, I'm looking at that these U.S. money funds hold roughly $1 trillion of debt issued by the big European banks. So we're talking about BNP Paribas, Deutsche Bank, Barclays, according to those analysts. And those banks, of course, that hold Greek and other European government bonds. So there is that exposure. Sounds like a lot. So be more specific. Make me feel more confident if I'm in a money market fund that I don't have anything to worry about.
Well, the number that you're referring to takes into account every financial institution throughout the European Union that money market funds currently are investing with. But we've been following this crisis for fully a year, and we've seen money market portfolio managers, as they have done for 30 years, adjust their portfolios based upon their credit analysis. They do this analysis on a name-by-name basis. They don't simply look at a region and say, well, we're not going to invest there. And the names that remain in the portfolios tend to be very large, very well-capitalized European banks, and frankly, that have maintained a prime rating on their short-term debt, which is what the money market funds are investing in.
You sound very confident. Let me just break in, because let's go back to the heart of the financial crisis when Lehman Brothers came down and we broke the buck on the reserve primary fund. I mean, nobody ever thought that would happen, and yet it did. Again, give me, you talk about some research, some numbers. You really do feel confident that none of this can happen here?
Well, the funds that we're talking about here aren't guaranteed. It's an investment objective of theirs to maintain a $1 value per share, and they've done that very well historically. But I don't think at this point we're looking at a similar situation that we faced in September in 2008. You have obviously problems with certain European nations, but you don't have the paralysis in the fixed income markets that you did in September of 2008, the depths of a liquidity crisis. What you have are specific issues with respect to some institutions and some jurisdictions. And look, what money fund portfolio managers have done for 30 years is the kind of very intensive credit analysis that they continue to do and have done throughout the Eurozone crisis for over a year now. And they've done it successfully.
Paul, just got about 30 seconds left here. I mean, one issue that you're very worried about is a floating share price. Right now, those money funds currently use a fixed share price of $1. How likely do you think we get that, which is what some regulators might be pushing for? Just quickly here.
Investors tell us if it's not $1 in and $1 out, you don't get my dollar. It's extremely important for us to maintain that stable $1 transactional value for money funds. Without it, this sector of our industry simply wouldn't exist. And the loss to American businesses, American communities would be very substantial, because the $2.7 trillion in funding that they provide, there's no ready alternative for.
Paul, we're going to leave it there. Paul Stevens of IC. I will obviously be listening out for that hearing and testimony tomorrow. Paul, thank you so much.
Thank you very much.